Most traders usually get caught in false breakouts because more often than not, they ignore and overlook the importance of volume. Price will give you a glimpse of direction, but volume is what shows you the real momentum behind every move. Without volume, you're just guessing and entering trades blindly. I totally get it. I mean, I used to be that way. Funny enough, I used to think that volume and price were the same thing. Same with support and resistance. I used to think that it's the same thing with order block, supply, and demand. Not until I found light. So I'm going to break down how volume can completely change the way you approach every trade. And if you're already familiar with volume but still struggle with it, you'll want to stick around for this lesson. This is not a financial advice, just for educational purposes. Anyways, my name is Z, and I've been trading forex for about 4 years now, and one thing I realized when I started trading is that many trading concepts are explained in a very complicated way, which makes it harder for beginners to truly understand the market. So my goal is to break down complex trading terms and strategies into simple, easy-to-understand explanations like I wish someone had taught me when I first started trading. So, without much talk, let's get started. Price movement just tells you what happened in the market, while volume literally tells how it happened. Guys, volume is the good guy. Price just lets you figure things out yourself. When you open your chart, the candlestick you see on your chart is just the result of volume. Don't worry, I'll explain. Price movement and volume are simply just effort versus results. For example, let's say a student dedicates several hours each day to reading, studying his textbooks, solving math, and following his study schedule without distraction. And after the exam, his grade came out excellent. What I want you to get from this example is that the student put in effort to study and got excellence as a result. If he doesn't put in the effort to study, he will still get a result at the end of the day, but it'll be a poor result. Or better still, he's going to fail as a result of lack of effort. Now, to bring it home, price shows the direction or the movement of the market, while volume tells you how many buyers or sellers are supporting the move. Volume tells us how much or how little people participated in a price move. So basically, volume is the effort that was made on an asset at a particular time, while price is the result. To simplify this, I'll use another example. A small volume bar can signify that 1,000 people supported or participated in a trade, but a long volume bar can signify that 1,000,000 people supported or participated in a trade. As a result of the 1,000 participants, price prints a small candle on the chart, and on the other hand, it prints a larger candle for the trade that over 1,000,000 people participated in. So you see, volume is the voice of the market, and price movement is stronger and more reliable when paired with your understanding of volume. Volume is that one additional technical analysis step that will help you fish out bad trades when you compare volume to the price movement. There are 3 things I'd love you to look out for when analyzing the market. Number 1 is a healthy move. A healthy move is when price movement and volume are the same, like a long volume bar and a long candlestick as well. When prices move either to the upside or downside, and this movement is backed by high trading volume, it signifies a healthy trend, and the move is not driven by just a few isolated transactions. A large number of traders or investors are buying or selling. So, volume and price movement should match. Number 2 is absorption. Absorption is when you see high trading volume, but the price barely moves. It means that there's a large amount of buying or selling happening, but the price is not responding to it as you might expect. The effort the participants are putting in is much, but the results are nothing to write home about. This is because there's something in the market that is absorbing those orders and hindering the result from reflecting in price. This hindrance is usually large opposing orders in the order book. When I say opposing orders, I mean a sell order and a buy order. For those at the back, an order book is where all buy and sell orders are listed in a market. When you click on a buy or a sell button on your MetaTrader and wait for the price to get there and trigger it, the buy or sell you clicked goes straight to an order book until someone is willing to buy or sell at your price. For every buy you clicked, you sold to someone, and for every sell you clicked, you bought from someone. So, when we say orders are absorbed, it means that there are enough orders at a certain price level to counterbalance the buying or selling pressure so the price doesn't move so much. Let's say the Euro USD current price is 1.2 thousand, and shortly buyers start entering the market and 10 million euros are being bought within just a few minutes. What you should see is a fat, juicy volume bar, and it should be accompanied by a clean price movement with fat, juicy candles. But you saw the complete opposite. Remember, we said Euro USD was at 1.2 thousand. The price only moves slightly, maybe from 1.2 thousand to 1.2005, and then delays. The reason the price isn't going up is because there's a large sell order at 1.2005. Immediately, 10 million euros were bought. A large sale took place. Let's say about 15 million euros were sold immediately at that price. So, even though 10 million euros are being bought, instead of the price going up, a large sell order is busy swallowing any buying orders. The buyers are trying to push the price up, but the large sell order is acting like a wall, absorbing all the buying pressure and preventing the price from moving significantly higher. Yes, the volume bars will be fat and juicy naturally because institutions can't totally hide their footprints. Honestly, they wish they could, but the good thing is that they can't. So, high volume with low price movement is a red flag. Sorry if you're single, but people in relationships can relate better. Anyways, moving on. The third thing to look out for is low supply or demand. When you see low volume bars on the chart, but price movement is moving significantly to the upside or to the downside. Price movements are largely influenced by supply and demand. When both supply and demand are low, it takes little effort to cause significant price movements. When both supply and demand are low, there are obviously few participants in the market. This makes it easier for a small number of traders to push the price higher or lower. This is a red flag as well. You only want to participate in the market when it is safe and healthy. Again, volume should match price movement. The volume bar on your chart works with your time frame. If you are on the 1-hour time frame, just as each candle represents a 1-hour trade, so does each of the volume bars represent a 1-hour trade volume. There was a misunderstanding I first had when I first started learning about volume. I genuinely thought that a green volume bar meant that many buyers participated and red meant many sellers participated. A large red volume bar means that there were many participants that supported the move, and a large green candle means that there were many participants that supported the move. A small red volume bar means that there were few participants that supported the move, and a small green volume bar means that there were few participants that supported the move. The volume bar is just green and red because candlesticks are green and red by default. There are some traders whose volume bar color is totally different from their candlestick color. This is because the color doesn't matter. The size of the volume bar is all you need. I'd also like to add that volume doesn't indicate the trend of the market. So, let's build the strategy step by step. Step 1. Scale up to the higher time frame, like the daily or weekly, and observe if there is unusual volume, like the absorption and low demand and supply technique we discussed earlier. Remember, you should be checking out the volume bar in the most recent price movement, not the price movement that happened weeks ago. Step 2. This is your key level. The fastest way to lose your peace of mind is to pay attention to every volume you randomly see on the chart. The only place you should observe after step 1 is how volume is displaying on your key level. If the price reaches your level and the volume is high, but you're seeing small price movement, you should know better by now that you're witnessing an absorption. Low volume with high price movement is already a red flag. Traders who trade breakouts, when they see a breakout with a low volume, have it in mind that more often than not, it's a trap, and when they see a breakout with a high volume but small price movement, it's risky and might be a fakeout. Step 3. Wait for confirmation. When the price is at your key level, don't blindly follow because you have seen your entry signal. Confirm price with volume. Remember that price movement should match volume. Price manipulation may lead to short-term moves, but volume reveals when price moves are backed by real market participants, making them more likely to last. Okay, that's it for this video. Drop me a like, drop your comments, and please subscribe to my channel, and I'll catch you on my next.